Japan's bond market is now officially broken. Whether we're looking at indicators of their bond market liquidity being the worst they've been in over a decade, or the fact that the Bank of Japan now owns over 2/3 of Japan's 10-year bonds, or the worst of these, that this 10-year bond failed to trade for 4 days at all. It didn't trade. We are looking at a bond market that is officially broken and coming soon to a central bank near you. Ready? Let's dive in. Let's take a step back and figure out how we got to where we are today in Japan. They spent decades printing money trying to cause inflation. But here's where culture comes in and makes a big difference. They did expand the base money supply, but not the broad money supply. These are very two different things. Think of this like bank money versus people's money. Now, in the fall of the financial crisis, what the Federal Reserve did and the government did was they replenished bank money, because bank money is like the foundation that people's money is built on. It's all just fugazi, it's all just nothingness, but that's the way the math works out. And so in order to make sure that the people's money stayed there, they had to make sure that the foundation underneath didn't crumble. Well, mortgage-backed securities and things like that, they thought banks had this much money. And then when they realized that that was worth nothing, they realized banks only had this much money. And so there wasn't enough money on top. It would have all crumbled. The foundation was gone. And so what they did was they replenished the bank's money so that the broad money supply, the people's money, would stay the same. And that's why you didn't see a giant increase in the broad money supply in the aftermath of 08 and 09. Yes, there was a little bit of a spike, but then it leveled out here, and it was nothing like what happened in 2020. Yes, the broad money supply was a lot more than it would have been if banks would have been allowed to collapse, because the money supply, the broad money supply here, would have collapsed. But that's also why we didn't see a lot of inflation after that, because the total money in circulation didn't really change that much after that. It stayed largely the same. Well, that's kind of like what Japan had been going through for years, trying to cause the broad money supply to increase. But the more money they printed, the more their people saved and paid off debt and deleveraged. And so there was a counteracting deflationary force from the people in Japan. Not to mention the fact that they've got surpluses when everybody in America thinks that the deficit is the normal way to live. In Japan, the country actually had surpluses, budget and trade. However, one of the ways that the Bank of Japan was trying to do this is by buying government bonds. And when you want to buy government bonds and be the one that buys them, you have to buy them at a price over or at least matching what other people would pay so that you get to be the one that buys them. Well, bonds prices are inversely correlated to their yields. That's how they work. It's not just something that might happen. It's something that has to happen. That means that when the central bank comes in to buy up bonds, pushes the price up, that pushes the yields low. So they pegged the 10-year rate for Japan's 10-year government bonds at basically zero, at 0.25%. And since that means that the government can loan money from the central bank at 0.25%, now nobody wants to buy those, because nobody wants to loan the government money at 0.25% because they're getting their purchasing power destroyed through inflation. Now, it's not a ton, but any inflation is worse than 0.25%. So we get something like this showing up where, because nobody wants to buy them, they go no bid. And the market liquidity for bonds in Japan is worse than it's been in decades. We also get this where the Bank of Japan owns more than 2/3 of Japan's 10-year notes, 67.2%. Now, the federal government of the United States has about $31 trillion. And so this would be like the Federal Reserve's balance sheet being $23 trillion and made up entirely of treasuries. The money printer is printing money to loan to the government, and the government owes money to the money printer. It's not real debt. It's just using the money printer to finance government spending. And this is the craziest part to me. These bonds failed to trade for 4 days. This is one of the most advanced and developed and richest countries on earth, and their government's bonds didn't trade for 4 days. Unfortunately, this is what happens when you get massive deficits, when you get massive ballooning of government debt, when you get yield curve control, when you get suppression of interest rates. You get all these problems that then you have to fix by even more of the same intervention. And this is what's coming to other economies. You get to a place place where all the money printing has caused so much inflation that nobody wants to own that debt anymore because it's a return-free risk. It's basically saying, I'm guaranteeing that I'll lose purchasing power to inflation, or I'm taking on the chance of losing everything to a default. It's a lose a little bit at best case scenario, lose a lot at worst case scenario. So nobody in their right minds wants to own that debt, so everybody starts to sell. Well, that creates a problem for the government, who still needs cheap financing, so the central bank has to step in and buy it all and start to loan cheap money to the government again. Well, that keeps rates low, which accelerates the problem of nobody wanting to own that debt because it doesn't pay enough, so the central bank ends up having to buy all of it, which means it's not real debt anymore. Because if a central bank is printing money to loan to a central government, it's not a loan. Because when it's repaid, even the interest, all the profits on that go back to the central government. It's just the central government nationalizing the central bank and turning debt into MMT. It is taking the central bank, the money printer, and using it for funding finances. You are no longer needing to tax or borrow. You can simply create as much purchasing power as you want out of thin air through the money printer, which, by the way, is just transferring purchasing power by force away from everybody without them actually knowing it, because they don't see the number coming out of their paycheck. All they see is prices going up. And the countries that are going to be having to do this, like Japan and like the UK and like Germany and eventually like the United States, this is not Venezuela. This is not Argentina. This is not Lebanon. This is not some of these countries that are developing in emerging markets with these situations over the last couple of decades that we in the West and in the developed world have said, oh, that could never happen here. We're actually rich. No, this is the most developed and most advanced economies in the world, and this is where it's happening. This is a sign that this system is crumbling. It can't last forever. It is coming to an end. The only question is, are we going to do it by allowing things to fall and fail naturally and let failure fail and let capitalism do what it's supposed to do, let free markets take their course, and let the corruption fail, and let the people who did the wrong things take the consequences of that? Or are we going to protect the failure, protect the corruption by transferring wealth away from everybody else in order to bail out the rich? I know which way I wish it would go, and unfortunately, I think I know which way it's going to go. But we'll see. And as things develop, as always, you will be the first to know. Thank you so much for watching. Have a great day.